Hello, everyone. Welcome to my class in Fundamentals in Accountancy, Business and Management 2. We have a new lesson today. That is the third method, the financial ratio analysis. In the past week, we studied the vertical and the horizontal analysis in making a financial statement analysis and interpretation. And today, we will be talking about ratios. Okay, what is a ratio analysis? Okay, a financial ratio analysis means we are looking into the relationship of the different accounts in the financial statements. And then their relationship, this relationship is expressed in terms of rate, percentage, or a proportion. You will notice that this ratio has a numerator and a denominator. Okay? And there are several ratios that we will be using. For example, we will be solving for the liquidity ratios. When we speak of liquidity ratios, it means we are measuring the capacity of the company to pay its current liabilities. Okay? The ability of the company to pay its short-term obligations. So I'll be giving you also the formulas, but for the liquidity, we have the current ratio and the quick ratio. Then we have here the solvency ratios. When we speak of solvency ratio, we are looking into the ability of the company to pay its long-term obligations. Or the question is the company able to pay its long-term liabilities? So the following ratios will be used: debt to equity ratio, debt ratio, equity ratio, and the interest coverage ratio. Then we also have the operating efficiency ratios. The operating efficiency ratio measures the capacity of the company to operate, to use its assets, use its assets like the fixed asset, the inventories, and the receivables to help them in the operations. How efficient are they in using these assets to generate sales? Okay. Next, we have here, okay, we will be giving you here an example exercise. Okay, I hope you join me now in this study because we will be giving examples in each ratio. Here shown is the balance sheet of ABC Company for 2019 and the income statement down below. Okay, here is the balance sheet, the assets, the liabilities, and the owner's equity, and the sales below. Next, we have, moving on, let's go to liquidity ratios. Again, ratios will measure the capacity of the company to pay its current liabilities. We will use the current ratio, and the formula is current assets divided by the current liabilities. So, 4,310,000 divided by 1,035,000 will give us 416.24 0.42%. So you will notice a very high percentage, meaning the company can pay its current liabilities by 416%. Okay? So to test more, if really the company can pay its current liabilities, we use a stricter ratio, which we call the quick acid test ratio. The quick assets divided by the current liabilities. The question is, Mom, what's the difference between the current assets and the quick assets? Okay, when we speak of current assets, we include the cash, the accounts receivable, marketable securities, inventories, and other prepayments. Okay, prepaid assets. But when we speak of quick assets, we do not include all these five. We only include those assets that are immediately immediately turned into cash. So among the five assets, maybe we can include the cash and the accounts receivable. Okay, if they're if they could be collected in the near future, then we could classify the what's this the accounts receivable and the marketable securities. It depends on how long or how soon can you translate or can you transform these two assets into cash. So quick assets for the in this case we will use only the cash and the accounts receivable. So again you will notice that the current assets has the amount of 4,310,000 while the quick assets has the amount of 4,305,000. So it is lesser than the current assets because we do not include all the current assets when we use the term quick assets. So 4,305,000 divided by the current liabilities of 1,035,000 will give us a lower value, 415.94. But in this case, still the company has a very good chance of being able to pay its current liabilities. Okay. Then we have also the working capital. The working capital means this is the fund that can be used for current operations. Okay? So the formula is the current assets minus the current liabilities. It will give us 3,275,000. This shows that the company has very has sufficient cash to pay its has sufficient assets, I mean, to pay its current liability of 1,035,000. Okay? Next, we have the solvency ratios. When we speak of solvency ratios again, what is it? Yes, solvency ratios means we measure the company's ability to pay its long-term liabilities. Liquidity means the capacity of the company to pay its short-term obligations, but solvency ratio means the capacity of the company to pay its long-term liabilities. And we use the following ratios to measure its solvency: the debt to equity ratio, the debt ratio, the equity ratio, and the interest coverage ratio. When we say debt to equity ratio, we measure the the company's liabilities, okay? The company's liabilities over its equity. So in this figure, we have a 30.22%. The total liabilities of 1,035,000 divided by 3,425,000, it gives us 30.22%. That means the company is able to the company can absorb its total liabilities when compared to your equity, okay, to the to the owner's contribution by 30.22%. Next, we have debt ratio. Debt ratio measures the company's assets. How much of the company's assets is coming from the liabilities or from creditors or from debts? This shows us that of the 4,460,000 assets, 1,035,000 is financed by creditors or by liabilities. Okay? So it shows us a debt to debt ratio of 23.21%. So that means your assets are financed by creditors by 23.21%. Okay. So your equity ratio is again the opposite. It shows us that your total assets is financed by your equity, by your investors by 76.80%. So this is much higher. So that means your assets are financed heavily by your investors or by the owners by 76.8%, and only 23% of your assets is financed by the outside creditors. So this shows a good credit standing. Okay, this is favorable to the company and even to the outside parties. Then number four is the interest coverage ratio. The interest coverage ratio shows that the capacity of the company to cover its interest expense. Okay, when the company borrows money, specifically in the bank, he has to pay its the company has to pay its interest expense. So this shows us that the company is very much able to pay its yearly interest expense. Okay, so it has only an interest expense of 2,000 as compared to its operating income. So they have sufficient operating income to cover the interest expense of the company. Okay, so next we have the operating efficiency ratios. Again, when we say operating efficiency ratios, we are looking into the capacity of the company to manage its assets. Okay, how good, how efficient are they in the management of their assets in such a way that these assets would contribute to their income or to their sales. So the first is the asset turnover. The formula is net sales over the average assets. The net sales is 3 million and the average assets is 4,460,000. So it's less than one time or 1:1 ratio. It's less than, it is 0.67 times. That means that 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 the assets of the company generates 0.67 centavos for every peso sales. Okay? 1 peso sale, for every 1 peso sale, 0.67 centavos of that is generated by your or is coming from your assets. Okay. Then we have also the fixed asset turnover. So this one is the fixed alone, the fixed asset alone. In our case, our fixed asset here is, I think, the machine. Okay, if you will look into your income statement, the fixed asset is your machine. So we will measure if the machine contributes to your sales. So net sales over the average fixed asset of 150,000, it shows 20 times. That means for every 1 peso sale, for every peso sale, the fixed asset of the company generates 20 times more. Okay, so the it shows that your fixed asset is contributing much to your sales. Okay, next we go to the assignment. Okay, you will notice that I did not discuss here the profitability ratio and the other efficiency ratios because this will be discussed more in the other video lesson because it will be taking so long if I put it all together here. So I prepared a different video for that. And I hope that you have to watch that video on the profitability and efficiency ratios together with this vlog, with this video lesson, so you will be able to answer the assignment. Okay, here is the assignment. You will look for the or solve for the liquidity ratios, solvency ratios, profitability, and operating ratios. Okay, then here is now the financial statement, the balance sheet on the top, and the income statement down below. Okay, using these figures or using this data, we will be able to get the relationship of these different accounts so that we will be able to express them into ratios. Okay, so given the examples above, I hope you will be able to answer this exercise. Okay, thank you very much for studying with me. And I would like to congratulate you. I have seen how persistent you were in your previous lessons, and I discovered in the Google Classroom that Almost 95% of you are getting it right. So thank you very much and God bless everyone. Again, this is At Your Service, ABM with Teacher John.